Where does the world's money go when it disappears from the map? About half of all international lending and deposits originate outside traditional financial oversight. Trillions of dollars of global wealth are routed through these networks, held in accounts and corporate structures that are invisible to the public. These locations are known as offshore financial centers. They are jurisdictions where the financial activity on the books is conducted overwhelmingly by non-residents at a scale that dwarfs the host country's domestic economy. This system is a network of legal and accounting structures designed to operate across borders. It creates specific financial conditions that sovereign nations typically regulate or tax. To understand how money moves through this system, we have to establish the boundary lines of corporate tax strategy. First, there is tax planning. This is the use of statutory deductions and government incentives to lower tax liabilities within the letter of the law. This outlines the spectrum of financial strategies. In the center is tax avoidance, exploiting loopholes to minimize taxes without breaking statutory laws. Then there is tax evasion, the intentional concealment of assets, fraudulent misrepresentation, and money laundering. It is illegal. Aggressive tax avoidance and illegal evasion rely on the same global offshore infrastructure to move money. The offshore system originated in London during the 1950s with the birth of the euro market. Look at this exchange floor. British banks began treating US dollar trades as if they were occurring completely outside of London's jurisdiction. They created a space for non-resident currency trading to thrive without local oversight. Following the success of the London model, financial institutions migrated this banking structure to Caribbean jurisdictions, establishing hubs in places like the Cayman Islands and the British Virgin Islands. The draw to these islands was practical. North American banks wanted a regulatory void combined with the convenience of New York's time zone and lower banking overhead. Legitimate bankers established the early offshore framework to create a space free from sovereign regulations, reserve requirements, and interest rate ceilings. Over decades, these centers developed specific tools to move wealth. The most common is the shell company. It holds financial assets but conducts no physical operations and employs no staff. They're used to manage cross-border investments and streamline mergers. These same structures can be used to disguise the origin of illicit funds. A shell company registered in a jurisdiction with strict secrecy laws provides cover to issue fake invoices and execute money laundering schemes. Wealthy individuals also use offshore trusts and foundations. These tools allow families to consolidate global assets and manage inheritance planning across generations. These trusts can also obscure beneficial ownership. By separating the control of the money from the person enjoying it, they make it difficult to identify who truly owns the underlying assets. Corporations employ royalty routing companies. A business will transfer its intellectual property to a shell entity in a zero-tax jurisdiction, then charge its own subsidiaries licensing fees to shift profits out of higher tax nations. The accumulation of these corporate tools makes it difficult for onshore authorities to track where money ends up or identify the true beneficiaries. If this toolkit enables tax erosion and financial secrecy, it raises a question: why do global governments allow it to exist? Offshore centers provide neutral ground for international trade. They offer the financial liquidity and tax efficiency required for cross-border investments to function. But that same anonymity acts as an incubator for human trafficking networks, domestic corruption, and transnational drug cartels. The features that make offshore centers efficient for global business also create national security risks. This is the OECD headquarters. Through initiatives like the Base Erosion and Profit Shifting Project, major economies began coordinating to close the loopholes that enable aggressive corporate tax planning. Under the new Common Reporting Standard, secretive jurisdictions were forced to begin sharing banking data across borders, ending decades of strict financial privacy. In the United States, the Financial Crimes Enforcement Network rolled out a beneficial ownership registry in 2024. It is a domestic effort to identify the real owners behind shell companies. Internal data leaks like the Panama and Pandora papers exposed the scale of offshore secrecy. These documents showed how powerful elites and multinational entities use the system to hide wealth from public scrutiny. While treaties provide the legal framework for transparency, whistleblowers have been the primary force bringing these records into the public eye. The economic consequences are measurable. sovereign nations lose public tax revenue annually, reducing the funds available for infrastructure and social welfare. This system distorts market competition. Multinational corporations utilizing offshore tax havens secure a financial advantage over local businesses that pay standard tax rates. These leaks fueled public anger over perceived double standards, as citizens watched elites operate by a different set of financial rules. Are offshore financial centers a necessary part of global capitalism, or a loophole that allows the wealthiest to play by different rules? The global economy currently operates with a fortified blind spot that regulators have yet to fully map.